Okay, here we are. Friday, what is it? April 8th. I'm back. I had my substitute last week. I watched it.
She rocked it, by the way.
Yeah, no, hey, I know. Okay. She's better in a lot of ways. But I think we got to up her production game. She looked like she was sitting in her closet filming it, right? So that's on us. We got to fix that.
That's true.
Because we got some more.
Agree.
More hockey tournaments coming up. We got summer vacation, stuff like that. So There's gonna have to be some more fill-in. So we'll definitely have to up our game. All right. What's going on? Market's choppy.
Yeah. The market hasn't changed. It's obviously a big week, though, from a information perspective, I guess, as Fed minutes came out middle of the week.
Yes.
And in Canada, we had the budget last night, which is big always news. Interesting. Big news. Yep. Lots to do. So the charts will be a couple of charts on housing. Since it was a housing budget, we're going to do a couple of charts on housing as well.
Sounds great. Sounds great. Yeah. I think you came out on the daily email today and said you didn't mind the budget.
Yes.
Right? That wording is very sitting on the fence for you, Ben, as we don't normally see you sitting on the fence.
It's nice and safe there.
Trying to figure out what side you're teetering towards, but you said, I don't mind the budget. You want to expand on that?
Yeah, I thought they came out with some balanced policies. It was nice to see them kind of not go crazy on spending, attack capital gains. They're looking to kind of close out some offshore loopholes that still exist in the system. Yeah, I think it was all right. The introduction of this housing account is interesting, which we can comment on a little bit. But I thought, they're thinking about what they can do in this current environment. And I think the ball lies more in the court of the central bank right now than it does federally. So I think it was probably a safe-ish budget to make both sides happy. From the perspective is we're not too much and we're giving a little bit over here. So that's what I'd say. It wasn't earth shattering like we've had over the years. Sometimes, the one that has always stood out the most is when they closed the loophole with the income trusts in Halloween of what year was that even now? Probably 15 years ago, where income trusts opened down kind of 30% after. So nothing crazy like that.
Okay. Just before we keep going here, if you disagree with Ben's comments about the budget or just with the budget, you have any questions or comments about it, put it in the questions there. I'd love to start a debate, ruffle Ben's feathers there on a Friday, like to get him going.
Exactly.
Yes. Don't be shy too. Don't be shy.
Let's we'll just have a brief talk about the housing piece that they did in the budget, and then we can jump in more to markets. But the one thing that they came out was this, I don't know what they're going to call it yet, but the first-time home buyers house count. And so I think it's a good concept, good idea. You can put in 8,000 a year up to a maximum of 40,000. You get a tax credit for investing it, and it's tax-free when you take it out. If you don't use it after 15 years, you have to close the account by either a tax-free transfer to your RSP or to a RIF. I don't know why they put RIF, because the likelihood of a first-time home buyer that'd be RIFing is pretty low. I guess it's probably to encompass everything. But if you have kids that have bought their first home in the last couple of months here, they've also changed the first-time home tax credit from 5,000 to 10,000, and they are allowing you to backdate that to January 1st. So there's some benefit you could have if you file that. So that piece I think was the most interesting for young people trying to get into the housing market, and it'll just be another kind of arrow in the quiver for people looking to save money.
Great. Yeah, no, I think it's good too. I think
Yeah.
Especially with
Yeah.
the housing, it's almost, I don't want to say it's forced savings because it's not forced, right? But it's definitely another vehicle, right, for people to get into the market because it's getting harder and harder, right? As rates go up and as prices go up too. So it's great. All right, Ben, what else you got?
Yeah, so because the market was choppier, I think a little bit quieter generally from a capital raising perspective. Not much new issues this week on the equity side. On the credit side, we saw province of Quebec come out multiple times this week. They raised I want to say close to $800 or $900 million this week. So some of that was on the long end to 2053, but most of that was in kind of the 10 range where they raised most of that money. So they're active coming to the market. So I guess they're showing up their balance sheets. But generally, it was a quieter week that week, and we're still in the chop from the perspective of equities, stocks, bonds, gold.
Gotcha. Did you want to talk about the bond market at all or no? We talked about that a little bit today. You're a bit surprised about its performance.
Yeah, so one of the if you read the daily today, and I have spoken about a little bit over the past multiple meetings, just kind of that similar setup to 2018, where Powell had been talking about, and it's the same Fed chair right now, but Powell had been talking about how hot the economy was leading into the end of 2018. We're on cruise control for raising rates. We're going to raise many times. The job market is hot, etc. So the story, market dropped about 25% in December of 18. And so very similar setup to what we saw then. I'm not saying it's going to play out exactly the same, but as we start to reach these levels on bonds, I've tried, I guess, my best to articulate what it means to own these types of bonds, but I thought a good way to go into it, at least in the daily, was what happened after that. After Powell had said those things, is that the 10-year bond basically went straight up. With about a 30% increase over about 16 months. And if you went further out the curve, and we have some exposure in 10 years and 30 years, but the further out the curve you went, like the TLT, which is long bonds, they're up, if I noted, 60%. I believe 60% on the 30 years. And if you went even further on the zero coupons, they were up 85% in the next 2 years. And so, as we have this discussion about, you can't make money in bonds, is kind of what the general media would say. And as I think about the risk reward over the next, 3 to 9 months, I would say, unless I'm completely misreading something, which is possible, that there's as good a setup as I've seen.
Great. So that being said, did you were you active in the portfolios this week, or just kind of wait and see?
Yeah, so couple of things. Looking at some kind of up bonds in case I am wrong. So bonds that'll pay a flat rate that steps up every year. So I've did a little bit of that this week, but yes, continue to add to bonds. And so where I made decisions, I've still been buying 10-year and the 30-year. I still think it's a good risk reward. And there's so much discussion around inflation, and this is really kind of the first bout of real high inflation that we've lived through from a cycle perspective. Yeah, there were other times where it was high. This is the first time we've been in the kind of 7-8% range from an perspective. So we can only go back and look, and saw what happened in history. And we had similar periods in the 40s, similar periods in the 70s, but not anything that we faced in our lifetime. So I think it's important to look at that and say, what's different about those two periods? Are we going to have the same type of outcome? And so if we're going to have the same type of outcome that we had in the 40s and 70s, that's pretty crappy for all assets. And so I think we have a much different demographic. We have a much different leadership in the central banks around the world. I know Powell was actually quoted Volcker, which was hilarious. And, you know, from a guy that's been the biggest dove of any Fed chair we've ever had. And so I think, you know, these guys haven't changed. And what we're going to see is them adjust and pivot to the realities of a slowing economy.
Gotcha.
Yeah.
Okay. Well, you know what it's time for?
Time for the charts.
Ben's charts.
I just kept it to 3 as per the rules.
That is the rules.
Keeping it intact.
3 charts. Everybody knows the rules. Here we go.
Exactly. All right. Just getting the screen up there. Give me 1 sec. It just keeps popping up in the other screen.
You're a bit glitchy too today. I don't know if it's your internet or mine, but it's a bit glitchy.
Bit glitchy. Okay.
Might just be mine though. Who knows?
All right. Let me know if you can see it.
Yep. You're up.
All right. All right. Excellent. So I've talked a lot about real estate, and as per the budget yesterday, as I said, there's been a lot of focus and attention around real estate. And you know, Scott, you worked in the real estate business for a long time, so I'm sure you have a lot of familiarity with how people think real estate's the only way to invest your money. So it's you know, I think about it a lot of ways, but real estate is one of the best ways to get leverage because the banks will give you 95% leverage on your asset. And so as we look at and think about how important real estate is in the world these days, and I comment on it and why I think real estate and interest rates are so friggin' important to what happens for the next little while, it's something that you know, really goes into my decision making around what is likely to happen and why I don't think central banks can raise rates anywhere near to what they say they plan to do without putting the global economy into a severe recession, if not depression. And so a couple of slides, first on globally, then one on Canada, and then one more. But this is a great slide, and this is, again, Macro Alf keeps coming up with these awesome pictures around some of the important things that go into thinking right now. And as you look at the breakdown of global assets, commercial real estate's 33 trillion, agriculture land 36 trillion, gold's 12 trillion, global GDP, that's the global GDP asset is 85 billion or trillion. Debt securities, which is an enormous market, is 123 trillion. Equities is 110 trillion. And if we look at the largest of all of these pieces, the largest asset in the world is residential real estate at 260 trillion.
Wow.
Yeah.
It's amazing.
It's amazing. It really is. And maybe intuitively some people knew this, but I didn't realize the scale and scope of it and why it's such an important piece that is going to make a deciding factor around what's going to happen with rates. And so since this makes up the major asset in the world, and if we look at Canada, for example, real estate's 10% of GDP, which is largest input, ahead of oil and gas now. So why I think it's so important is that, you know, the objective of these central planners is to make us feel more wealthy so we spend more money. And with the current backdrop with rising rates and tightening financial conditions everywhere, I'm not sure how they're able to stick handle that unless I'm missing something completely.
Right. Okay, good one.
Okay.
Yep.
And so are we stuck in the middle of here, or can you see clearly?
No, I can see it. No, yeah.
Okay, perfect. Yeah. Yep. Yeah, and so I've spoken about this a little bit over the years, but the one thing that happened in the US was in 2008, everyone remembers, we saw housing prices correct, subprime crisis, yada, yada, saw huge in housing prices. And if you see on here, obviously this is correct. This is the correction, and this is disposable income is the black line. And so if we look at Canada from the same perspective, disposable income, we saw a bump in disposable income inventories, but this was a result of the CERB and the business. That's where the money pumped in there. But if we look at the red line, we saw a huge here in and around 2000. And so as I look at this and think about this, as I'm sure some other people do, this is housing prices, this is disposable income. I don't know what that gap is. Like, I'm not sure how that continues to sustain. And as we saw in the budget last night, is they banned foreign buyers, foreign investors. And borrowing costs have skyrocketed. And so where a year ago you could get a 5-year fixed at 157, or north of 4%, you will get 4% somewhere, less than 4% at some of the places looking to lend more. But this is a giant gap that isn't going to be fixed by a couple little tinkering pieces that the government yesterday. And so as I look at it, I understand the dynamics of supply that people tell me this is the reason prices are so high, is because there's not enough supply. And so I would say, yeah, that's part of it. But there's a huge glut of supply likely to hit the market in the second half of this year. And so higher rates and supply coming on, I don't know how we think that maybe the Bank of Canada can raise rates to 4% on the short end. To me, that looks like a big recession. And if they choose to go that route to combat inflation, which is possible, I don't think they will, but it's possible. And every recession historically, the long end of that bond curve drops down back towards zero, and historically has gone lower than its previous low. And if we look at US 10-year rates anyways, they went down to 54 basis points in March of 2020. And so I'd say the likelihood of what we're seeing right now is we're seeing massive tightening, and we're seeing prices have to come down. And so, this is as scary a chart as I've seen, and one that I think makes you really think about what the next couple of years are going to look like, especially as these governments are talking so aggressively right now.
Right.
Yeah.
Yeah, that's it's hard to believe that prices will come down to a correction that'd be reasonable compared to what the increase has been, though, right? Like, you're not going to see a 20% drawdown on house prices, and I don't think, or you think they will. Is that what you're saying?
If they go to 4%, that's a best case scenario.
Yeah.
Percent down.
Yeah. Well,
so if they go to 4%, it's probably a 50% correction.
Right. Which has never happened, I don't think, right? I don't think that's ever happened.
Not on average as a country. Not on average as a country. Yeah. So I think that it's extremely unlikely that the central banks will choose to take that course of action and fight inflation no matter what, which is what they're saying now and why the bond market is so spooked. I do think that they will change because they want to have, they want to protect the economy, and a big recession is not something that the global economy can handle right now.
Yeah. It'll be interesting because there's such a small foreclosure market, like in an environment like that, you'd like 20% drawdowns, you'd think that you'd have a reasonable sized foreclosure market. The US has a massive foreclosure market. That's why you saw, 50% people taking 50% of what they bought their home for. But in Canada, it's a bit different. The mortgage practices are quite a bit different. So it'll be interesting to see, I can't see them keep going up, but I just don't know where the money's coming from the average family. So interesting. Yeah, for sure.
Yeah, and it's fair. And I think that just showing the gap here shows that, the people buying the houses isn't the everyday person being able to buy at this level. They're getting help to do it in places, and there's not enough income to support the price. Like that's a clear anomaly. And CMHC themselves have said, we don't want anymore. We want the housing market to slow down. Can't handle it.
Yeah,
Like it's putting our business at risk.
for sure.
So yeah.
Okay, great. What do you got?
Cheery
Last one.
Let's
Yeah.
So I'd say, a little bit. Yeah, try to continue to keep on what's happening here. I did have listened this week to a couple of interesting presentations. One was with Rosenberg and Steph Pomboy, which is from macro perspective. But I listened to Raul interview an investor, kind of a long-term macro investor that's focusing now on crypto and blockchain. But it's interesting, all of these businesses that are out there that are spending a lot of money, and these ones you probably recognize a lot of companies.
Sure.
And the top, the right hand side is kind of the leaders now in blockchain of the big corporate America or corporate global companies. They continue to focus on and put money heavily invested in blockchain. And so one of the interview questions that Raul had to this guy was, what kind of companies do you think are investing in blockchain right now? And so, typically people would talk like Coinbase or, some of the crypto names, Axie Infinity, stuff like that. And he said he recently attended an event, and Dolce Gabbana was the kind of the lead sponsor of the event. And it was an NFT event. And as you look at all of these companies, the big corporate companies looking, they're saying, how do we participate in this space? And there's a lot of money moving towards it. So I think it's important that we think about the evolution of it. And we think about, some of these are great companies that you could look to invest in that are trying to participate in the future as well. So we try to look for those as they continue to show themselves.
Love that.
Yep.
Love that. And that's just more proof right there that, blockchain really is the Web 3.0, right? I mean, it is the future for sure.
Yep.
There's a lot of smart companies, a lot of smart people behind these things. They wouldn't just jump in blindly.
Yep.
All right, that's it for Ben's charts.
For the charts, I see there might be a question down there.
We do have a question from Lyle. You want to get into that?
Okay, sure. No, that's okay. I just saw it pop up there.
No, we can get into it. All right. What does Lyle want to know? He wants to know.
I'm scared.
Yeah, I know. You should be. This week, Yellen declared that the Ukraine-Russian war would have catastrophic effects on the world and world economy. So other than impact on wheat, oil, and gas commodities, what else is catastrophically affected? Am I missing something? Is Lyle missing something?
It's rare that Lyle misses something, but I would say some of the things happening below the surface are probably the risks that she's seeing that we don't necessarily see today. So I did make a small reference in my daily around high yield. And so Europe hasn't had a high yield issuance in 5 months. Last time that's happened was 2011, just as we're going into European crisis. So, I think as we look at least events that have happened over the last, well, that was 10 plus years ago now, but even in recent periods where August a couple of years ago, the high yield credit market essentially ground to a halt, and that caused Powell to panic. And so I think the risk probably that she's referencing, which is the contagion risk that we're starting to see in the system, is that companies are running out of money. They're having more difficulty raising money. High yield is such a giant part of the financial system allowed to continue to operate. And so I think that's likely what she's referencing, is that we're getting a really tight system. If companies start to not be able to raise money, and if we have a risk at any point where JP Morgan says we don't trust Citigroup anymore with their lending, and the kind of the liquidity that exists in the system evaporates, then I think that's probably the risk that she's referencing. And just to a point on that, I've had a couple of conversations this week about things are still robust in the US because they're stimulating the system. And so, as we head into the second quarter of this year, all of that stimulus runs off. And so we're talking about $1 trillion less stimulus. And the Fed has talked about, spending $1 trillion less with their bond buying. So you're seeing kind of liquidity in the US drop by about 2 trillion. And that's what that lubes the financial system.
Lyle clapped back. As we're a bunch of children on here. Okay. Lyle claps back. I like the answer, but why is that a consequence of the war, Ben?
Because, well, one of the big things that has happened is the Russian banks have been pulled out of the financial system. So the whole SWIFT system has jeopardized right now. And so if the SWIFT system is jeopardized, kind of that point-to-point transaction that used to exist isn't there anymore. And we're starting to see, a little less distrust happening in the system. And, we saw the ECB today say, we're putting together a plan to provide more liquidity because we're seeing concerns about not enough in the bond market. And so the ECB's already recognized that, well, the economy is slowing quite quickly. We're seeing potential contagion in the banking system. We're seeing Putin not back off. So we're going to have an energy crisis here. And so you're getting so many things happening at the same time, that I think if it existed in it as itself, and this was 21 or like last year, where the economy was just starting to come out of it, interest rates were still low. I don't think she'd be saying that, because I don't think it's a risk, but because the economy's slow, rates have already moved up, and now we're seeing an additional supply chain crisis. It's probably the worst possible time something like this could happen to Europe specifically.
There you go. Okay. Well, rolling out, this has been like the longest one we've ever done, I think. But so what do you have? What's in the crystal ball? What do we see for next week?
Yeah, so lots more to follow, but the biggest, I think, news point next week will be Bank of Canada's meeting on the 14th. That's next week, yeah. With their rate increase announcement. The market's pricing in a 50 basis point increase in Canada. So anything on the either side of that will cause an adjustment to assets. If they went more than that, bonds would sell off. If they go less than that, bonds will rally. So certainly pay attention to what's happening there. But I'd say the likelihood of them raising next week 50 basis points very, very high. So we'll be watching that announcement, what they say. Some of these data points that I talked about today will be coming in, and they'll this, but that'd be the biggest, I think, from a news perspective next week. Also, it's a shortened week. Friday is Good Friday, so markets are closed in Canada and the US. So options expiry is on Thursday, which is a weird kind of timing setup, and lots of options expiring next Friday. So that may result in a bit of a choppier Thursday, and we'll do the roundup on Thursday next week.
Good to know. Put that in the calendar.
Yeah.
Anything else you want to talk about?
I think that's it.
There's a lot we didn't get to, right?
Mm-hmm.
We didn't talk about the tax coming up on the big banks. We didn't. Did you talk about last week? Elon Elon Musk joining Twitter. Did we talk about that?
No.
Jeez, we haven't talked about that. Kathy
Yeah.
Wood says that big banks have a big problem thanks to crypto.
Mhm.
Peter Thiel calling Warren Buffett a sociopath. You know, all the news. Anyway, if you haven't read any of that, go and find it because we're out of time today. But
That's it. That's it.
If there's nothing else, like you said in the opening, there's a lot of markets have been kind of choppy. Nothing that interesting, but a lot of information this week. So that certainly is. Okay, everybody. Thanks for joining. Glad to be back, and we'll see you next Thursday.
Sounds good. Take care.
Bye now.